All right, ready to dive in. Today, we're tackling your questions about index funds. And judging by your research stack, it seems like you want the raw facts, not just the sales pitch. Especially with inflation looming large, whispers about hidden costs, and those lost decades everyone's worried about. You're wondering if index funds really live up to the hype.
Love the healthy skepticism. Smart investing starts with understanding both the potential rewards and the risks. Let's dig into those concerns head on, look at the data, and see what's really going on.
Perfect. Let's start with everyone's least favorite guest, inflation. It's like that uninvited guest who eats all the snacks before the party even starts. Your research suggests it eats away at index fund returns, leaving you with, well, not much. What's the reality check?
Okay, let's talk inflation. Yeah, it's a factor you can't ignore.
Yeah.
Let's take the Spanish market since 2000 as an example. Official data shows cumulative inflation of 75%, averaging about 2.3% yearly. That's like adding a couple of extra cents to every dollar you spend, every year.
Okay, yeah, I'm feeling my wallet getting lighter already.
Now, let's see if index funds can outpace this inflation monster. We'll use the MSCI World Index as our benchmark. Think of it as a popularity contest for 3,000 of the biggest global companies. This index is a solid representation of a well-diversified index fund, and since 1987, it's returned roughly 8.67% per year.
Hold on, so even with inflation taking its 2.3% bite each year, we're still ahead with that 8.67% return.
Exactly. You're not just keeping pace with inflation, you're potentially growing your wealth. Imagine hopping in a time machine back to 2000 with $10,000 and investing it in this index fund. Fast forward through the ups and downs, the trends, the events to the year 2030. Even with inflation, you could be looking at around $67,257, almost 7 times your initial investment.
Wow, now that's fighting inflation. But what about the classic under the mattress strategy?
The mattress strategy seems safe, but it might actually lose you money. After 30 years of inflation, that $10,000 would have shrunk to about $5,000 in purchasing power.
Ouch, so I could be losing money even when I'm not investing. I'm starting to see the appeal of outpacing inflation. But my research also uncovered some scary stories about lost decades where investments actually lose value, like riding a roller coaster that only goes down.
Market cycles are a reality we can't ignore. Let's look at the S&P 500, another popular index fund benchmark. Between 2000 and 2013, it had some really rough patches. Imagine investing right before the dot-com bubble burst in 2000. You wouldn't have seen positive returns for over a decade.
That's a long time to wait, like planting a tree and waiting a decade to see if it bears fruit. Any way to avoid those lost periods?
We can't eliminate risk completely, but there are strategies to navigate those market dips. One is dollar cost averaging. Instead of investing a lump sum all at once, you invest consistently over time a bit every month or quarter, regardless of market conditions.
So you're not putting all your eggs in one basket at one specific time. Is that why it's effective?
That's part of it. When the market dips and prices are lower, your consistent contributions buy more shares. Then, when the market recovers, those shares you bought at a discount could potentially lead to greater returns. Plus, it takes the emotion out of investing, which can be a game changer.
It's like having a steady hand on the wheel through those market twists and turns, instead of making impulsive decisions.
Exactly. And historically, the S&P 500 has always bounced back from even the worst crashes.
So instead of fearing downturns, we should think of them as potential buying opportunities.
That's a great way to look at it.
This makes me think about diversification, that don't put all your eggs in one basket advice. How did that play in?
Diversification is like having a backup generator for your portfolio when the power goes out. You're not putting all your faith in one stock or asset class, but spreading your investments across different assets, like with the all-weather portfolio.
An all-weather portfolio. What is that exactly?
It's designed to withstand any economic condition by combining different investments: stocks, bonds, gold, even real estate. The idea is that even if one asset class is down, others might be holding steady or even going up.
A built-in shock absorber for your portfolio.
Exactly.
I'm starting to see how these strategies can make a real difference. But what about taxes? My research mentioned they can take a big bite out of index fund gains.
It's a common concern, but the good news is investment income isn't taxed the same way as your regular income. There are special tax brackets for capital gains, which are generally more favorable. And importantly, you only pay taxes when you sell your investments and realize those gains, not while they're growing.
Okay, so it's not like every time my index fund goes up, the tax man is at my door. That's a relief.
Not at all. You have more control than that. Capital gains taxes kick in when you decide to sell and lock in a profit.
Got it. It's less about being taxed constantly and more about strategic selling.
Mm-hmm.
So how can someone be smart about minimizing that tax bite when they do decide to sell?
One strategy is to sell what you need when you need it. If you have a good amount, say $1 million, and a large chunk is profit, you don't have to cash it all in at once. Let's say you need $30,000 for a kitchen remodel. You could sell just enough of your investment to cover that instead of selling everything and getting hit with a huge tax bill all at once.
That's a really practical tip. Strategic selling is key. But what about people who need access to their wealth without selling their investments and facing those taxes? Are there options for that?
Absolutely. You can tap into your wealth without saying goodbye to your investments. One popular strategy, especially for those with significant wealth, is borrowing against your investments.
Borrowing against your investments, that's interesting. How does that work?
Think of it like this. You're using your investment portfolio as collateral to secure a loan. This way, you get access to funds without actually selling your assets and triggering a taxable event.
That's clever.
Right.
Having your cake and eating it too, accessing your wealth without selling investments or getting hit with a massive tax bill.
Precisely. It's a more advanced strategy, but it shows there are ways to invest while being tax efficient.
This is incredibly helpful. So far, we've tackled inflation, navigated volatility, and demystified hidden costs. But before we move on, I want to revisit values-based investing. You mentioned ways to align investments with personal values, and I'm really curious to explore that further.
I'm happy to dive into that. It's something I'm passionate about. More and more investors are looking beyond financial returns. They want their money to support companies that align with their personal values.
You're talking about ESG investing, right? Environmental, social, and governance factors.
Jax, people are realizing their investments are a powerful tool that can support companies tackling climate change, promoting diversity, or upholding strong ethical practices.
And this is especially relevant for index funds since they track a broad range of companies, right?
That's right. With a traditional index fund, you're invested in many companies, some of which might not align with your personal values.
So you could unintentionally support businesses or practices you wouldn't necessarily choose if you were picking individual stocks.
It's something a lot of investors are thinking about, and for good reason. But the good news is there's been a lot of innovation in this area. Now you can find ESG-focused index funds.
So you can have your cake and eat it too. Align your investments with your values without giving up the benefits of index funds.
Exactly. And the options are growing. There are index funds focused on renewable energy, gender diversity, sustainable agriculture, you name it.
That's amazing. It's like taking the power and potential of index funds and adding purpose and intention.
That's a great way to put it. It's about recognizing that your investment decisions have a real-world impact, and you can choose to make that impact positive.
I love that. It's not just about growing your wealth. It's about growing it in a way that aligns with your values and potentially makes the world a better place.
You've got it. It's about recognizing that finance can be a force for good.
We've covered so much today. Inflation, volatility, those hidden costs, and even ESG investing. As we wrap up this part of our deep dive, what's the one key takeaway you want our listeners to remember?
If there's one thing to remember, it's that knowledge is power. It's about asking questions, challenging assumptions, and understanding the tools you have to make informed decisions about your financial future.
And that's what the deep dive is all about, informed curiosity.
Absolutely. When you arm yourself with knowledge and a curious mind, you can face those financial decisions with more confidence.
On that note, we'll leave you with something to think about. How can the strategies we've discussed apply to other areas of your life? Think about it. Dollar cost, averaging your time and energy towards your goals, diversifying your skills and experiences, even aligning your career choices with your values. The possibilities are endless. Thanks for joining us on this deep dive. We'll see you in the next part, where we'll explore even more about index funds and answer more of your burning questions. We covered a lot of ground in the last part, from inflation to those roller coaster market swings. But before we wrap up this deep dive, I wanted to circle back to something you mentioned about values-based investing with index funds. This idea of aligning your investments with your values really struck a chord with me.
Yeah, it's something I'm really passionate about. It's inspiring to see more investors looking beyond just financial returns. They want their investments to reflect their values, to do good.
You're talking about ESG investing, right?
Right.
Environmental, social, and governance factors.
Exactly. People are realizing their investments have power. They can support companies tackling big issues. Climate change, diversity, ethical practices, you name it.
It feels like a big shift from just making money to making a difference with that money.
Absolutely. And it's not just a feel-good thing. Investors are seeing that companies prioritizing ESG factors might actually be better positioned for the long term.
That makes sense. Companies with strong environmental practices are probably less vulnerable to things like resource scarcity or regulation changes.
Right. Or think about a company known for good governance. Strong ethics usually mean less risk for investors, too.
It's like you're not just picking stocks, you're investing in a better future.
Exactly. And here's the exciting part for index fund investors. You can now find index funds built around ESG principles.
So you can have both align your investments with your values without losing the benefits of index funds. How does that even work?
It's all in how these special index funds are put together. Instead of tracking the whole market, they follow indexes made up of companies that meet certain ESG criteria.
So for example, if I'm passionate about clean energy, I could find an index fund focused on companies in that sector.
Exactly. Or say you care about gender equality. There are index funds tracking companies with strong records on diversity in leadership or fair labor practices in their supply chains.
Wow, that's incredible. Taking the simplicity of index funds and making them even more impactful.
Exactly. Your investment choices have a ripple effect. You have the power to decide what kind of impact you want to make.
I love that. It's not just about growing your wealth. It's about growing it in a way that aligns with your values and makes the world a better place.
You've got it. Recognizing that finance can be a force for good.
This is eye-opening. We've gone from debunking myths to uncovering ways to align our investments with our values. As we wrap up, what's the one message you want to leave with our listener?
I'd say the biggest takeaway is this. Knowledge is your most valuable asset. Ask questions, challenge assumptions, and make sure you understand the tools and strategies available.
That's what we're all about here on The Deep Dive. Informed curiosity.
I love that. Approaching investing with a curious mind empowers you to make informed decisions about your financial future.
And with that, we'll leave you with something to ponder. How can you apply this informed curiosity beyond investing? Think about it. Approaching your career, relationships, even your hobbies with curiosity can lead to incredible growth. Thanks for joining us on this deep dive into the world of index funds. We've covered a lot, but we've only just scratched the surface. That being said, I think we've given you a lot to think about. Until next time, keep exploring, keep questioning, and keep investing in your knowledge and a future you believe in. You know, it's pretty amazing when you think about it, knowing that your investment choices can actually help create a better future.
It really is. It shows a change in how we see money and its potential.
Totally. It's not just about personal gain anymore. It's about aligning your money with your values, contributing to something bigger.
Exactly. And that brings up something really important, something people often miss when they start investing, especially with index funds.
Okay, I'm intrigued. What's this crucial point?
Having a clear investment strategy. It's like having a roadmap.
That makes sense.
Yeah.
You wouldn't go on a road trip without a map, right?
Exactly. Same with investing. Your strategy helps you define your goals, understand your risk tolerance, and make smart decisions along the way.
So, how do we start creating this investment roadmap? What are the key stops?
First stop, figuring out your why. What are your financial goals? What are you hoping to achieve with your investments?
Seems obvious, but I get how you could get caught up in the excitement of investing and forget to think about the bigger picture.
It happens all the time. Take a moment to think about it. Saving for retirement, down payment on a house, your kids' education. What are you working towards?
And once you've got those goals figured out, what's next?
Next stop is figuring out your risk tolerance. How comfortable are you with the market's ups and downs?
That's a big one. Some people can handle those swings, others not so much.
Exactly. And there's no right or wrong answer. It's about knowing yourself and picking investments that match.
So someone who's more cautious might choose a safer approach, while someone comfortable with risk might be open to strategies with potentially bigger payoffs.
You got it. It's about finding that balance where you can sleep at night, knowing you're invested in a way that feels right for you.
Makes sense. So how does this all connect back to index funds?
That's the great thing about index funds. They're super flexible tools for your roadmap.
So no matter your goals or risk tolerance, there's probably an index fund strategy that works.
Exactly. You can adjust your approach based on your time frame, your comfort with risk, even your values, like we talked about with ESG investing.
This has been an incredible journey, from understanding the basics to creating our own investment roadmaps.
And remember, it's a marathon, not a sprint. Investing is for the long haul, so start small, learn as you go, and grow your investments over time.
As we wrap up our deep dive, what's the one golden nugget of wisdom you'd share?
Never stop learning. The world of finance is constantly changing. Stay curious, ask questions, and always look for reliable information.
That constant learning is what makes investing so interesting, like exploring a huge, ever-changing world.
Perfectly said. And remember, you don't have to explore alone. There are resources, experts, and yeah, even podcasts like this one to help guide you.
Well, we've reached the end of our deep dive into index funds. But for you, this is just the beginning. As you continue exploring investing, keep that same curiosity, that thirst for knowledge that brought you here. Until next time, keep asking those questions, keep searching for those aha moments, and keep investing in your knowledge and in a future you believe in. From both of us here at The Deep Dive, thanks for joining us and happy investing.